For most of the 20th century, buying a house in America followed a simple ritual. You saved for years and put 20% down. A banker looked you in the eye, checked your income, checked your debts, and decided whether you could carry the weight of a 30-year mortgage. It was slow and boring, but it worked because defaults were rare, banks were stable, and the housing market moved in gentle, predictable waves. Then, in the early 2000s, someone decided that was not good enough. The rules were rewritten, the safeguards were removed, and a machine was built that within 6 years would destroy $19 trillion in household wealth, erase 8 million jobs, and bring the global financial system closer to total collapse than at any point since the Great Depression. It started with 5 words on a billboard: "Why rent when you can own?" The year was 2002, and America was bruised. The dot-com bubble had burst 2 years earlier, evaporating trillions in stock market wealth, and the September 11th attacks had shaken the nation to its core. Consumer confidence was fragile, and businesses were cautious. The economy was sliding toward stagnation, so the Federal Reserve, under Chairman Alan Greenspan, responded with the only tool it trusted. It cut interest rates, again and again, down to levels not seen in a generation. The goal was to make borrowing so cheap that spending would restart on its own. It worked. Money began to flow and credit loosened as the entire country turned its attention to real estate. Home ownership in America was never just a financial decision. It was identity, stability, a white picket fence, and a patch of lawn that said you had made it. Politicians from both parties championed it, lenders marketed it, and the message was everywhere. On television, on billboards, in bank lobbies, at mortgage seminars held in hotel ballrooms across the country. You deserve a home. You can afford a home, and we will make it happen. Banks did not just agree with this message, they industrialized it. Lending standards that had existed for decades were quietly dismantled as income verification became optional, down payments disappeared, and credit scores that would have disqualified a borrower 5 years earlier were now considered acceptable. The industry invented a product called the Ninja Loan. No income, no job, no assets, no problem. Part-time workers earning minimum wage were approved for $500,000 mortgages. Baristas with $5 in savings were handed keys to luxury condos. It was absurd and reckless, but it was enormously profitable for everyone in the chain, at least for a while. The mortgage brokers did not care whether borrowers could repay. They had no intention of holding the loans, so they would originate the mortgage, collect their commission, and sell it to a larger bank before the first payment was even due. The larger bank did not care either, because it planned to bundle the loan with thousands of others and sell the package to investors. Nobody in the pipeline had any incentive to ask the obvious question. The only incentive was to keep the conveyor belt moving. Speed was rewarded and caution was punished. A loan officer who turned down applications was a loan officer who did not last long. Underneath all of it sat a single assumption: housing prices always go up. Every chart confirmed it, and every neighbor who doubled their money in 6 months confirmed it further. It was treated as a law of nature, as reliable as gravity. Nobody asked what would happen if that assumption turned out to be wrong. Asking that question was considered pessimistic, even foolish. The people who asked it were ignored, and the people who acted on it were laughed at until they were proven right. By 2005, real estate in America had stopped being about shelter. It had become a casino. People were buying houses the way day traders bought stocks during the dot-com bubble, fast, leveraged, and without any intention of holding long-term. Phonics teachers flipped condos on the weekends, while hairdressers owned 3 rental properties. Television shows about house flipping drew millions of viewers. The entire culture was soaked in the idea that real estate was a guaranteed path to wealth, that the only mistake you could make was not buying enough. The frenzy fed on itself. Every sale at a higher price validated the last one, pulling in the next wave of buyers terrified of being left behind. It was a feedback loop with no braking mechanism. Prices in cities like Las Vegas, Phoenix, and Miami doubled in 3 years. Construction cranes filled every skyline. Entire neighborhoods were built on speculation, row after row of identical houses waiting for buyers who existed only in projection spreadsheets. Television shows about house flipping drew millions of viewers and made celebrities out of amateur investors whose only qualification was timing. The message was simple and universal. Real estate is the safest bet in America, so get in now or get left behind. But beneath the granite countertops and the open floor plans, something was rotting. The loans that were fueling this boom were not just risky, but rotten to the core. And Wall Street had figured out how to take that rot, package it in a suit and tie, and sell it to the world. The mechanics of what happened next are often described as complicated. They are not complicated at all, just straightforward and deeply cynical. Banks that had originated millions of subprime mortgages did not want to hold them. Holding a bad loan means absorbing the loss when the borrower defaults, so they sold the loans, not individually but in bulk. Thousands of mortgages were bundled together into packages called mortgage-backed securities. These packages were sliced into layers, ranked by risk, and sold to investors around the world as safe, reliable, income-generating assets. The critical ingredient that made this work was the rating. For an investor to buy a mortgage-backed security, it needed a grade from one of the major ratings agencies. And the agencies gave these bundles of subprime garbage the highest possible rating, AAA. The same grade given to U.S. Treasury bonds, the same grade that pension funds and insurance companies required before they could invest. Why would a ratings agency stamp a pile of ninja loans as AAA? Because the agency was being paid by the bank that created the product. The bank would shop its bundle to multiple agencies. Whichever agency gave the best rating got the business. The incentive was not to be accurate, but to be accommodating. Internal emails later uncovered by congressional investigators showed analysts at these agencies joking about the quality of the deals they approved. They knew exactly what they were approving, and they did it anyway. Wall Street was not finished. It took those already questionable mortgage-backed securities and repackaged them into an even more opaque product called a collateralized debt obligation, or CDO. The concept was layered complexity designed to obscure what was inside. Through rounds of financial engineering, loans that no honest analyst would touch were transformed into investment-grade assets with AAA stamps on the cover. Pension funds bought them for the retirement accounts of teachers and firefighters. Insurance companies bought them to back the policies of millions of families. Sovereign wealth funds in Norway, Singapore, and the Middle East bought them as conservative holdings. The toxic waste was distributed across the entire global financial system, and almost nobody looked inside to see what they had actually purchased. The few who did were horrified. Almost nobody. A small group of investors did the one thing that nobody else was willing to do. Most of them were outsiders, with no ties to the Wall Street establishment. They read the fine print and looked at the individual loans inside the securities, where they found adjustable rates about to reset, borrowers with no documented income, and a system built on a foundation of sand. And they reached a conclusion that the rest of the financial world considered insane. This was going to collapse. The problem was that no financial product existed that allowed you to bet against the housing market. So these investors walked into the offices of the biggest banks on Wall Street and asked them to create one. The banks were delighted and designed a product called a credit default swap. It functioned like an insurance policy on mortgage-backed securities. The investors would pay a monthly premium, and if the securities failed, the bank would pay out. The banks were certain they were collecting free money. Housing always goes up, and everyone knew that. There was one twist that turned the product from questionable to insane. You did not have to own the mortgage-backed security to buy insurance on it. Anyone could bet against anyone else's investment. It was the equivalent of buying fire insurance on a stranger's house. Billions of dollars in credit default swaps were written as the premiums flowed in and Wall Street celebrated, while the investors on the other side of the trade waited. The first cracks appeared in 2007, quietly at first. A foreclosure here, a missed payment there, a condo in Las Vegas sitting on the market with no offers. The Federal Reserve Chairman told Congress that the problems in the subprime market would likely be contained. Analysts on television explained them away. The consensus was firm, and everyone insisted the fundamentals were strong. They were not strong. By early 2008, housing prices were falling across the country, not in isolated pockets, but everywhere, simultaneously and without warning. And the speed of the decline caught the entire system off guard. The subprime borrowers started defaulting in waves. Their adjustable rates reset, doubling and tripling monthly payments overnight. A family that had been paying $1,200 a month suddenly owed $2,800. People who had been told to never worry discovered their homes were now worth less than their mortgages. They were trapped in homes they could not sell, could not refinance, and could no longer afford. So they stopped paying. Foreclosure signs appeared on streets that had been lined with sold signs 2 years earlier. Entire subdivisions sat empty as swimming pools turned green, and the American dream decomposed in real time. The defaults destroyed the mortgage-backed securities. The Securities destroyed the CDOs, and the CDOs triggered the credit default swaps. And suddenly, the biggest banks in the world owed trillions of dollars on bets they never believed they would lose. Bear Stearns fell first. In March 2008, it was sold to JP Morgan Chase in an emergency deal for $2 per share. 12 months earlier, the stock had been trading above $150. Then Fannie Mae and Freddie Mac were placed into federal conservatorship. These two government-backed entities guaranteed half the mortgages in America, and the government effectively nationalized the housing market overnight. And then came the day the world changed. September 15, 2008. Lehman Brothers, a 158-year-old institution with $600 billion in assets, filed for bankruptcy. There was no bailout, no rescue, and no last-minute deal, just a crater in the center of the global financial system and a single terrifying message. If Lehman Brothers can fail, nothing is safe. The panic was instantaneous. Banks stopped lending to each other overnight. The credit markets froze solid, and the invisible machinery that keeps the global economy running ground to a halt. Money market funds started breaking the buck, despite being considered among the safest investments in existence. The Dow Jones lost nearly 800 points in a single session. In Iceland, all three major banks collapsed within a week. Markets from Tokyo to London to Sao Paulo went into freefall. The question was no longer which bank was next, but whether the system itself would survive. The United States government faced a choice with no good options. Let the banks burn and risk a depression that would make the 1930s look mild, or hand hundreds of billions of taxpayer dollars to the very institutions that caused the disaster. They chose the money. In October 2008, Congress approved the Troubled Asset Relief Program. $700 billion in emergency funds, because the logic was brutal but honest. These banks were not too big to fail. They were too interconnected to fail, because their collapse would not be contained to Wall Street. It would cascade through every business, every payroll, every pension, every mortgage in the country, and beyond. AIG had written trillions in credit default swaps without setting aside the reserves to cover them, and received over $180 billion in government aid. It was the single largest bailout of a private company in American history. General Motors and Chrysler got $80 billion between them after being crushed by the collapse in consumer spending. The Federal Reserve slashed interest rates to zero and launched a program called quantitative easing, a simple mechanism where the Fed created money electronically and used it to buy toxic assets off bank balance sheets. Critics called it printing money out of thin air, and in practical terms, that is exactly what it was. The Fed's balance sheet ballooned from $900 billion to over $2 trillion in a matter of months. Over the following decade, successive rounds of quantitative easing would push it near $9 trillion, as the emergency tool became the default response to every economic slowdown. Slowly, the bleeding stopped as markets stabilized and banks unclinched. The stock market hit its bottom in March 2009 and began a long, grinding recovery. Wall Street exhaled, but the damage to Main Street was already done. The numbers told a devastating story. Unemployment reached 10%, 8 million jobs vanished, and 4 million homes were foreclosed. $19 trillion in household wealth disappeared. An entire generation entered the workforce into the worst economy in 70 years. Retirement accounts that people had spent decades building were cut in half. Families that had never missed a single payment found themselves owing more than their homes were worth. Communities that had been thriving suburbs 2 years earlier became ghost towns of boarded windows and overgrown lawns. Soup kitchens could not keep up with the lines. Unemployment offices looked like disaster relief camps. The injustice of the aftermath was worse than the crisis itself. The banks that caused the collapse were rescued. Their executives received bonuses within months of being bailed out, and their stock prices recovered. The ordinary people who had followed the advice those banks gave them and bought houses they were told they could afford and trusted the system to protect them received nothing. No rescue, no bonus, just foreclosure notices, unemployment lines, and food stamps. In 2011, thousands gathered in Zuccotti Park in New York City. The signs read, "We are the 99%. The rage was not just about money, but about a system that seemed designed to privatize profits and socialize losses. When the banks won, the executives kept the winnings, but when they lost, the public paid the bill. And the accountability was zero, since not a single major Wall Street CEO went to prison, and the legal consequences amounted to fines. Fines that the banks paid from their profits and wrote off as operating expenses. The message was unmistakable. If you rob a gas station, you go to jail, but if you rob a country, you pay a fine and retire to the Hamptons. Congress passed the Dodd-Frank Act in 2010. It was the most ambitious financial regulation since the 1930s. New oversight agencies were created, capital requirements were raised, and speculative trading was restricted. But the lobbying started before the ink was dry, as banks spent billions chipping away at the rules. By the time the dust settled, many provisions had been diluted, delayed, or quietly repealed. The fundamental architecture of the system remained intact. A handful of institutions too large and too interconnected to be allowed to fail still dominated the financial landscape. What happened in 2008 did not come from nowhere. It followed a logic that was visible to anyone willing to look. Cheap money created reckless lending. Reckless lending created toxic assets, and toxic assets were disguised and distributed globally. And when the disguise fell away, the entire structure collapsed. Every person in the chain had rational incentives to keep the machine running and no incentive to question it. The mortgage broker earned a commission on volume, the bank earned fees on securitization, the ratings agency earned fees on ratings, and the investor earned yield on AAA paper. Every link in the chain was profitable, and every link in the chain was rotten. The people who built the machine walked away rich, while the people who trusted it lost everything. That pattern did not end in 2008, but evolved. The leverage returned, the speculation returned, and the blind faith in assets that only go up returned along with them. The instruments are more complex now, the numbers are larger, the interconnections between global markets are deeper and more fragile, and the next crisis will not look like the last one. It never does, but it will arrive wearing a suit and a smile, promising safety and steady returns, right up until the moment the floor gives way. Because the most dangerous lie in finance is never the one someone tells you, it is the one that everyone already believes.